So give us your take though first in terms of looking at the economy right now and what you see, because I see economic data that has slowed, but I almost think it's to the point where the US Federal Reserve, and we're kind of hearing that from them this week, that they won't have to be as aggressive in raising rates. It's almost as though we've got maybe a bit of a simmering aspect, and that's why, I pre-tape this on a Friday. We said the market's up yesterday and they're up again today. I mean, it's still early in the day, but we'll see. So what's your take?
The Fed's plan that has been evidenced since the last FOMC meeting through the series of speeches and the minutes, which really didn't teach us anything new, was always to front load the rate hikes. This is a decision they came to somewhere between the March and the May meetings to try and get the front end rate up to something they consider neutral. So somewhere between 2 and 2.5%. A series of 350 basis point hikes, and then slow the rate hike process as they got to the maximum caps in balance sheet runoff, which will occur in September. And so the market came to grips with that path. And then because inflation has been falling and housing indicators are starting to weaken, the markets decided that they may have, or the markets essentially got ahead of the Fed's plan, and that terminal Fed funds rate priced, you could look at September Fed funds futures, for example, has come down about 40 basis points. But I don't really think there's any change in the Fed's plan. I just think the market got ahead of what the Fed was thinking. And so we've just kind of settled into okay, we get what the Fed's going to do, and it's not so bad sort of idea.
Okay. And so, Barry, that's the Fed. And when we bring this home to viewers who aren't in the weeds like you are and I have been in my past life and still like to be a little bit here. Everybody right now is seeing WTI at $114. People are feeling the inflation effects. They're seeing it in their food and their gas. There's more and more CEOs and corporates talking about food scarcity. Can you just talk a little bit about what people are actually feeling? And then we'll translate it into your outlook.
Sure. I think there's a couple of interesting aspects of the inflationary move. One is if you take a very long-term time horizon and you look at the percentage of consumer spending that goes to food now versus the 70s, it's about 50% is the total disposable income that is committed to food. The same thing is true of energy. So while we've had a shock in those prices have moved up a lot, they're still much lower than they were in the 70s. And so if you combine that with what's going on with income and wages, where the lowest quintile wage earners their wages are going up 3% faster than the highest quintile wage earners. This is the strongest differential we've had since the late 1990s. So you have income going up at the low end. You have a very strong labor market, and you just don't have that same sensitivity to those things that you had back in the 70s. Now, that doesn't make it any better for people having to adjust to it, but it certainly means that they can withstand it far more than they could back in the 70s. What it does mean, though, for sure, is it's a huge political issue for the Democratic Party. And you can point to any of the approval ratings, generic congressional polls, any of those things, and it does portend the consumer confidence indicators. It portends a change in November for sure. That could take you off on a whole other line of discussion in terms of what it means for policies and particular sectors. But it's a political issue as much as anything else at this point.
Interesting. So it's not something that really weighs on your economic or market outlook.
Well, growth was always going to slow in 2022. The question is, will it be slow? And so if you step back and you think about consumer spending in the first 5 years following the global financial crisis, when household debt was at record levels, household net worth had taken a massive hit because of declines in house prices and declines in the stock market. We had consumption in the US average 1.8% per year for the first 5 years of the recovery. That's against a post-World War II average of 3.4%. In the back half of the 2010s, when the deleveraging slowed and household net worth had stabilized and begun to grow again, that rate of consumption or trend consumption increased to 3%.